Hi everyone, this is KT here. So today's video is about 20 premium boosters to capture more yield in every trade. So I put this PDF on Gumroad. So I'm going to do a video on these 20 premium boosters. So after hearing this video, you think that you want to give some support, you can just purchase this PDF. But nevertheless, regardless, we will still continue with this video on explaining what are the 20 premium boosters that I do that I can get a little more premium as compared to the average person. So let's go and take a look at the first booster. So the first booster is just to always use limit orders instead of market orders. And because market orders actually gives you the worst view is equivalent to losing your premium. The limit orders actually give us more control and we get more fairer views. So how does it looks like? I give an example here. So let's take a look at the stocks then. I will take a look at SoFi here. So SoFi, we look at the options tab here. So let's say now you want to sell a put option. Let's see. Let's find a better example. Spread here. So probably let's say put option at $28 here. You can see that the bid and the ask price, there's a difference of 0.10 here. So if you use a market order, you will just get $3.30 for this. But if you use a limit order, you can change it and then you can put 3.33 or 3.4 and you get an extra edge over here, like extra 0.04 or extra 0.05 for doing so. So that is the uh, principle of the limit order law here. Next, midpoint edge, it's the same. It's just that there's an ask and bid spread, so it's better to just put it in the midpoint, and usually you'll get filled. So with this, you can gain that extra percentage, extra premium here. So you will have to boost your premium without added risk. So example here, 3.35, 3.3, you put in 3.33 or 3.32, you get it filled as comparing to just getting 3.3. So this is one trick we can do, like 4.85 here to 4.95, you put 4.9. That is a midpoint. You get that gain the extra premium for doing so. Next, I think this is basically we stick to a tight spread instead of a wide spread here. Like this, you can maximize your options premium capture here. So just now so let's say 0.1 is considered a wide spread as compared to uh this 2.64 to 2.68. The spread is 0.4. The spread here 3.3 to 3.4 is 0.1. The spread is 0.04 compared to 0.1. Obviously, at $27, the spread is tighter. It's more it's better to sell options at a narrow spread. So you won't lose a lot of premium in those right spreads. Next, let's see the extreme anchor. So basically, it's just when we put in a order here, because you are selling options, right? So you need to get the most maximum. You instead of from the mid price, we start from 0.68. You put in an order. If it gets filled, that's good for you. If it doesn't get filled, you start to go down and down and down. So you start from the edge instead of from the midpoint itself. That can get an additional premium here. Especially for volatile stocks because it's volatile, right? So um, as the minute passes, it might hit your extreme end instead of the midpoint. So after this, you have the tick trick. So it's just basically uh you want to sell 2.67, it doesn't get filled. You go down 2.66, 2.65, 2.64. Eventually to the midpoint you will get filled. So that's the tick trick. Yeah, so you capture extra premiums that adds up significantly over time. Now, number six here, booster six. Basically, it's talking about time of the day. So when market starts, everybody will start to have their orders queue in. So there's a lot of volatility there. So if you sell options at the start of the day, you get richer premiums here. And towards the end of the day, you will have tighter spreads and you will have lesser premium. So if you want to sell options, do it when the market just open. Mm. Okay. Next, the 1 minute window. 1 minute window is just to say that using the charts to identify brief spikes in the volatility, then sell options to capture the extra premium. So basically, how do we look at the 1 minute window here? We just take a look at the uh, let's say SoFi here. We look at the code here. You change to 1 minute. So let's say you want to buy options and you want to sell, you want to buy options. You want to buy a call option or you want to buy a put option. So if you want to buy a call option, right? Example, it will be best if you want to buy a call option when the price is down. Then you buy a call option. It will be best if you want to buy a put option if your price is up. So by monitoring the 1 minute graph, right, you are able to find the ideal position for you to buy call options or to buy put options that will be useful for a straddle. Yeah. So this is just one example. And with this principle in mind, we can do it for selling of put options and selling for call options also. Okay. Back here, booster number 8, closing bell edge. So it just says that when market close, the market makers will try to balance the book, so the spreads will get tighter and tighter, easy to fill. So before the end of the day, you can try to do some trades, and your trades will be easily filled here. And booster 9, the weekend grab. So basically, I will sell my options in the last 15 minutes on the Friday, so that any new positions I can gain the extrinsic value over Saturday and Sunday. Because options lose the value as day passes by, they lose the time decay here. So if you place your trades on Friday, you get the extra 2 days of premium decay. So that's the booster for weekend grab here. So Friday decay trick is just saying that on Friday itself, because options usually expire on the Friday, and well, you can try to do a 1 day selling of options on Friday itself to capture the full decay. Uh, and also, I want to say that on Friday itself, because option starts to expire when the closing bell ends. So there is a very fast acceleration of time decay on the last half an hour to 1 hour. So that it's where your options can get expire out of the money or in the money. So if you want to do it, you can just sell options on the Friday itself. Next booster will be uh, booster 11 is about the IV checkpoint here. So basically, when you want to look at options, you look at the IV rank. If IV rank is high, you sell options, you get a fat premium. If it's low, then it's better to buy options instead. So usually when it's zero, it's very cheap. If it's near 100, it's expensive. So towards near 100, it's best to sell options. Towards zero, it's best to buy options. So how to see it? Let's take a look. Usually I will look at Decay Trick here to look at the IV rank here. So as you can see that IV rank for Adobe, it's quite high, 87.5. So it's best to sell options for this stock ticker. Whereas for, let's see, what's this? News Corp, it's best to buy options because the IV rank is low. So that's how you use like IV rank to buy and sell options. So let's take a look at the volatility Dow. So you have to see how far out of the money options should you sell, or whether depends on your high IV, you want to sell at further OTM or low IV to move closer to ATM. But to me, I think that basically at the money options which you sell, you will get the highest rate of return. So let's take a look at example here. So let's find a stock price that is the money here. Let's see. So we can look at STZ 145.9. At the money, I think 146. 146 will net you the greatest premium here. So that's about $2 here. And as you see, when you are out of the money, your premium you get is 1.55. And uh, in the money is 2.52 point something. So you can see that the difference in the premium. How you gonna take a look at this? You see, at the money, right? Let's say it's 146, you get $2 here. If at 147, you should be getting $2 plus $1. It should be $3 of premium in order to do so. And here 146, right? You're getting $2 here. If you're selling at 145, your premium you should get $1. But you're getting $1.45 to $1.70 here. So you can see that it's more worth it to sell your options at the money is a sweet spot. Uh in the and out of the money and in the money is also a sweet spot here. Um I think you just need to check which is more worth it. Usually, I will take a look and see. In this case, I think I will sell at 146 if I want to. If I want to be safe, I'll sell at 145. If not, 147 is totally not worth the premium for me. Okay. So back here, little down. Let's look at the DT calculator. So I think for this is just to optimize your options premium. As you can see, let's take a look at 145 here is $1.58 here. 145 1 week later, it's about $2 and 60 something cents here. And then 3 weeks later is $3.30. You can see the increment is slowly decreasing as the week pass. So let's say it's constant. That means like 160 to 260. So it's $1 constant. So the next September 6th, I would be looking at 360 here. But I'm not looking at 360. So you can see that the premium decreases. So you have to find the correct DTE to sell your options. Next, let's see DT. So, so this also affects whether you want to sell 1 week expiration or 2 to 3 weeks expiration. It really depends. For me, I would prefer to sell 1 week options to expire, so that I use my accessibility, and then as long it expire out the money and continue selling. So of course, in volatile markets, maybe 3 weeks expiration might be better for high IV here. You can capture more premium here. But however, depends on individual. I would prefer to sell 1 week because it's faster to know that whether my positions are expiring out the money and I have accessibility and can continue to do more trades. And also my option expire faster. I harness the maximum amount of premium I could get. Next year, next booster is the earnings flip. So basically during earnings, right, it's a lot of volatility. So it could make or break you. So that's why the reward potential is high, but so is the risk. So we have to weigh the risk and only enter trades if the potential assignment outcome fits the overall strategy. So for here, I think you have to do some research. So let's say we look at Oracle here. That's a earnings here, Tuesday '09. So if you look at the premium for this week, Oracle will have a high premium. So let's take a look. So I think it's this week, right? So premiums is quite high for this. Let's see. Oh, it's today. Earnings estimate, revenue estimate. Okay, probably end of the market day here. So if we look at the premiums here, 10:45, 10:55. So for a $240 stock here, you get $10.45. So how much would that be? So you take $10.45 divided by 40 times 100. That's about 4.35% for a 1 week gain. So that's why earnings, the premium is quite high for this. Okay. So, and also there's a lot of volatility ongoing for this Oracle stock here. Next. Okay. Just a valuation filter here. Only will undervalue stocks. So, skip the penny stocks here. So we will always look at the undervalue. So for me, I always look at let's say here undervalued stocks. I will look at, let's say, Google. Look at valuation here. It's undervalued. Current price is 235 and fair value is 241. So I definitely will pick Google as a ideal candidate to do a whale. Let's take a look at AMD here. So is AMD undervalued? Currently, it's still undervalued. Okay, let's look at something that's overvalued. Maybe Nvidia is overvalued. Yeah, Nvidia is overvalued, so I wouldn't get into Nvidia here. So this is just to illustrate this. And number 17, yeah, so basically I'm using a real strategy. I'm selling puts, and then if I get a sign, I will sell calls, and so it expires. So basically I want to hold this stock forever. It's just momentary that the stock price has a bearish price action. So If I sell puts, it's just like buying stocks here. And then I only sell puts that I'm happy to own. So when I get assigned, I can sell calls. So, and then with the discipline, I keep on rolling. And then when price action becomes bullish, the whole stock will get assigned or get called away. So throughout this whole journey, I'll be keep on earning the premiums, gaining by selling puts and also selling calls when you expire out the money. So number 18, triple rule roll. So I will only roll when I gain more credit, roll only when I gain more time, roll only when I improve the strike price. So I think I have a video talking about my percentage value. I roll when it's less than 50% or more than 100%. And when I roll, I always ensure that I will gain more credit. And if I don't want to get a sign, I would prefer to, let's take a look at this. No, and when I want to, how to say, when I don't want my options to get assigned, then I will roll it to a longer date of expiration. And if uh, I don't want to get the sign, then I'll roll down to be nearer to the spot price instead. So I won't get a sign for this. So this is just a rule to roll, but overall it should be a net credit gain. Next, premium ladder. So it's just to say that we will try to stagger to ensure that every week we will have options expiring, so that we diversify risk and smooth income. We also prevent all eggs from expiring on one Friday, ensure steady, consistent premium flow. So this is just telling try to have many positions expiring at different weeks, so you have a constant income. Okay, last booster, I would say sell the options at the strike price at psychological target price. Usually it's a whole number, a rounded up number, $100, 150, $200. Yeah. So these round numbers will act as a so-called a wall for buyers or sellers. And also they give better feels and also bigger premiums. So I think that's all. It's a very fast explanation, but if you really want to go into the uh, intricate details, probably I need to have uh, a video for each booster and then maybe talk about it 5 to 10 minutes. Yeah. So just a recap, small ages compound into big returns. So each of the 20 premium booster can add 1 to 5% yield compounded over time. These small ages deliver outsized gains. So spread your trades across different expiration dates for a smoother income stream and reduce risk. And from limit orders to tight spreads, take advantage of the way market and market makers operate. So use the midpoint, or you can start by using the anchor principle. So timing is also important. Capitalize on intraday volatility, weekend decay, and capture the juiciest premiums. So overall, mastering these 20 premium booster can help you capture more yield, and also compound into outsized returns over time. So end of the day, yeah. So this hopefully this 20 booster will help you to boost your profits. I believe some of the boosters will already help you to gain more premium already just by following this. Okay, so I think that's all. So just going back here, if you think that this is it adds some value, probably you can support just by buying this presentation. And then if there's any questions, you can drop me a note or email, and then I will just explain more. Yeah, but only for those who make a purchase. So at least there's some priority given to answer some questions here. Okay. So I think that's all. So have a great day, everyone. Signing off here.